Thank you. Steve Leisman, CNBC. Mr. Chairman, we've had several months of economic data that's been stronger than most forecasters expected. Employment was over 200,000. Unemployment rates come down to 8.5%. But there seems to be very little mention of this recent strength in the statement. Do you and the committee, Mr. Chairman, harbor doubts about the recent strength in the economy? And are you and the committee baking in additional quantitative easing in order to achieve the growth rates that you've even forecast here? Thank you.
Steve, there have certainly been some encouraging news recently. We've seen slightly better performance in the labor market. Consumer sentiment has improved. Industrial production has been relatively strong. So there are some positive signs, no doubt. At the same time, we've had mixed results in some other areas, such as retail sales, and we continue to see headwinds emanating from Europe, coming from the slowing global economy, and some other factors as well. So, we are obviously hoping that the strength we saw in the fourth quarter and in recent data will continue into 2012. But we're going to continue to monitor that situation. I don't think we're ready to declare that we've entered a new, stronger phase at this point. We'll continue to look at the data. We will, as I've said in my statement, and as we have in fact in the FOMC statement, we continue to review our holdings, our portfolio holdings, securities, and we are prepared to take further steps in that direction if we see that the recovery is faltering or if inflation is not moving towards target. So that's an option that's certainly on the table. I think it would be premature to say definitively one way or the other, but we continue to look at that option, and if conditions warrant, we will certainly consider using it.
Thank you. I'm a little confused by these forecasts. I was hoping you could sort of help me understand what we're looking at. It seems to say that you expect that at the end of 2014, unemployment will be at or above 7%, inflation will be at or below 2%, and yet 11 of the 17 members of your committee think that will be a good moment to start raising interest rates again. If unemployment and inflation are in fact symmetric objectives for the Fed, how can that possibly be the case? And is there any tolerance for above-trend inflation in the service of catch-up growth?
Well, let me first observe that we have, in fact, of course, been very accommodative in the last couple of years. We've kept interest rates close to zero. We've done 2 rounds of asset purchases. We have announced today, in fact, an extension of the period over which we expect to see rates very low, and our maturity extension program is still ongoing. So we maintain a quite accommodative path of policy at this point. I would further say that I think it's important to emphasize that we're not going to mechanically take the interest rate projections that participants provide and just build policy off of that. I mean, it's still going to be necessary for the committee to exercise collective judgment, to consider the costs and risks of additional policy actions, to discuss the uncertainty about the forecasts and other factors that come into the policy decision. Now, all that being said, if inflation is going to remain below target for an extended period and unemployment progress is very slow, then I think your implicit question is right. There is a case for additional policy action, and we'll, we want to continue to observe the situation, but we're certainly prepared to look for different ways to provide support to the economy if, in fact, we have this unsatisfactory situation.
Craig, right here.
Hi, Mr. Chairman. Craig Torres from Bloomberg News. Congrats on the inflation target or goal. That's a big achievement for you, I'm sure. I'd like to ask if you could explain a little bit the way you think inflation is now working in the economy. The 2012 central tendency's kind of low. And along with that question, I'd like to know where you think full employment is in the near term, like next year or two, given the structural impediments many Fed officials have been talking about.
Well, there are a number of factors that make us expect inflation to be quite low in the next couple of years. Certainly, we are seeing a reversal, or at least a flattening out of the commodity price increases that caused headline inflation to rise earlier in 2011. And futures markets and our own estimates of supply and demand globally with a slowing global economy suggest that most likely, although of course there's a lot of uncertainty, that commodity prices will remain well controlled over the next couple of years. On top of that, of course, we have a very high rate of unemployment. Pressure on wages is quite restrained. And putting that together with strong productivity gains, the costs of production, unit labor costs, are growing very slowly. Expectations of inflation seem well anchored, and in fact have been on the low side relative to recent history in recent months. So for all those reasons, inflation looks to be at or modestly below the 2% target going forward. With respect to the maximum employment measure, we have been providing, in fact, for 4 years, as long as we've been providing the economic projections, an estimate of the long-run sustainable rate of unemployment, which is currently, the central tendency is currently 5.2 to 6%. That is higher than it was a couple of years ago, reflecting structural impediments and other changes. We're concerned that the large amount of long-term unemployment may be causing some workers to lose skills or lose labor force attachment, which, at least for a while, will also likely increase the so-called natural rate or sustainable rate of unemployment. So there are a number of factors working in that direction. But in any case, while there's certainly a lot of uncertainty about exactly where the natural rate of unemployment is, clearly at 8.5%, I think we're comfortably above anybody's estimate, and for that reason, we still consider the labor market to be obviously quite slack.
John?
Thank you. John Hilsenrath from the Wall Street Journal. Mr. Chairman, how much confidence do you have in the FOMC's ability to forecast the economy and inflation out 3 years? And consequently, how much confidence do you have in the interest rate projections that the Fed has made public today, particularly the ones that go out to 2014 and beyond? And if I may add a follow-up to that, there seems to be an asymmetry in these dots in that there's a view that the view that matters the most at the Fed is the view of the chairman. So when we look at these projections, are we really seeing the most likely expected path of interest rates because the chairman's view isn't represented exclusively here?
Well, on your first question, our ability to forecast 3 and 4 years out is obviously very limited. There's no question about that. Nevertheless, we have to make a best guess, a provisional plan, in the same way that a firm making an investment has to make a best guess, a provisional plan about where the economy and the industry is going to be over a number of years. And so it's certainly possible that that we will be either too optimistic or too pessimistic, in which case we'll have to adjust both our forecasts and our policy expectations. That being said, currently the zero lower bound on policy rates, at least according to many estimates, is still binding. That is, even if the economy were a bit stronger, the very low interest rates we currently have would still be valid, still be appropriate. And so for that reason, unless there's a substantial strengthening of the economy in the near term, I would think that it's a pretty good guess that we will be keeping rates low for some time from now. We don't identify the specific individuals who provide the projections. Among other reasons, we want to make sure that people come to the meeting willing to talk and not wedded to a specific position. And that's why, again, the committee makes a collective decision after using as input these projections, which are circulated to all the members of the committee before the meeting so that they can see what their colleagues believe. As far as what individual members do believe, we certainly have other vehicles for expressing our views. All of us give speeches. All of us give interviews, and I give frequent testimony. So there's plenty of opportunities to get a sense of what individual members believe. But again, we felt that this information, which presents both the diversity of views on the committee, but also shows you where the central tendencies lie, would be useful. And I guess I might add to that, the chairman's term is not infinite. At some point there'll be a new chairman, but there's a lot more continuity on the FOMC collectively. The average bank president is on the FOMC for as much as 10 years, and governors' terms are 14 years. So even as the chairman changes, much of the FOMC remains continuous. So as we talk about interest rates in 2014, the fact that there is quite wide-ranging agreement that interest rates will be low for a long time should give you more confidence that that's not dependent on a single individual.
Greg Ip and then Greg Robb.
Greg Ip of The Economist. Mr. Chairman, the Fed's statutory goals are price stability and maximum employment, but traditionally the Fed has interpreted that somewhat flexibly in the sense that if there was a conflict between the two, they would push for price stability rather than full employment, on the view that over time, stable prices was the best contribution monetary policy could make to maximum employment. But today you went to some pains to say that actually you treat these goals, put them on an equal footing, and that there might be circumstances in which you put one above the other. So following up a little bit on Benjamin's question, do I take it that if inflation were to move somewhat above your 2% preferred level, that you would tolerate that in order to make further progress on unemployment?
Well, the period of time, yes, we treat them symmetrically. We cannot control, of course, where inflation and unemployment are at each moment in time, and so there'll be periods when, for reasons outside of our control, inflation and unemployment will move away from their desired levels. And in those situations, the speed at which, I think tolerate might be too strong a word, but because we always want to get everything, both sides of the mandate, back to their desired levels, but the speed at which we would enforce that return would depend on what's happening with the other variable. So, for example, if inflation did go above target by a modest amount, we would certainly try to get it back down to target, but if unemployment were very high, that would lead us to be more cautious and slower in returning to target. So that's why medium term, which is these targets are all medium term, is a flexible concept, and it depends on the initial conditions, how far away the two key variables are from their objectives at the beginning of the process.
Greg Robb.
Thank you. Greg Robb, MarketWatch. Mr. Chairman, thank you. You haven't had a very good time in all the Republican presidential debates. And I was wondering if I could have your comment on what you've heard. And some of the analysts I talked to said that one of the reasons for this hostility, perhaps, is that a lot of the Republican primary voters are on fixed incomes and have an inability to invest and make money with their funds. So could you talk to them as well? And one more thing, if Republicans take back the White House in November and ask you to resign, would you?